Hey, good afternoon. The date is February 27, and we're going to go on to the next chapter in 230, which deals with current liabilities. We're going to learn a little bit about contingent liabilities and accruals and things like that. So let us get started here. And let me share a screen with you all. Share screen. Okay, I trust we can see the screen. And we're going to talk about current liabilities. To start, we know what current liability is. Any debt that's going to be satisfied within a year. We owe somebody money, we need to pay it within a year. That is a current liability. Otherwise, non-current liabilities. Describe current and non-current liabilities. Liabilities is due to a past transaction or event. We bought some supplies from one of our vendors, and the deal is we pay the person in 60 days. That's a non-current. That's a current liability. Company has an obligation after the transaction, and you know that there is a future payment involved. Okay. Current liabilities due within 1 year. Long-term liabilities due after 1 year, or the company's accounting cycle if longer. That could be perhaps for a farm where the vagaries of the weather set back the harvest season. It might go into 13 months. But for the most part, we're talking 1 year being the cycle of a company, the fiscal year. Current and long-term liabilities due within 1 year. I bet you're getting tired of me saying that, huh? Long-term liabilities are due after 1 year. And they're just showing you a few companies with their debts here. Wow, hard to believe. Columbia Sportswear, look at the size of this company. $369.3 million worth of debt. Apple, though, look how big Apple is. $79 million worth of debt. Uncertainty and liabilities. I think we're going to talk now about some contingent liabilities. Uncertainty and liabilities. Sometimes somebody is not able to pay and is uncertain if they're going to pay or how much. That requires some accounting work. Identify and describe known current liabilities. Well, you already know about, I would say, most of them. Accounts payable, money you owe to your suppliers, sales tax payable. If you collected sales tax from a particular company or customer, unearned revenues, that's the money you receive in advance of doing the work. We've talked about that one quite a lot. You could have a note payable, short-term or long-term, payroll, and then some other types of liabilities. Let's look at a brief example of sales tax. Home Depot sold materials for $6,000, subject to a 5% sales tax. Well, 5% of 6,000 is $300, okay? So when the customer paid Home Depot got a check for $6,300. The 6,000 is the sale. That's not going to change. But the 300 creates a liability called sales tax payable. That is not Home Depot's money. That's the customer's money. Home Depot has a fiduciary duty to turn that money over to the appropriate state at tax time. Okay? So you have a credit to sales taxes payable. Unearned revenue. On June 30, Selena Gomez, wow, boy, that's my favorite, huh? Selena Gomez sells $5 million in tickets for 8 concerts, okay? The tickets were sold in advance of her performance. So you will debit cash. Selena Gomez will debit cash and credit unearned ticket revenue. That is a liability. That's a liability. She owes not money to the people who paid her. She owes performances. So she got the money in June. October 31st, she performed a concert. How about that? And that concert we figured was 1/8 of the 8 concerts she promised. So at that point, we debit the unearned revenue, which is a liability, and we credit ticket revenue. We've been over this before. I'm pretty sure you're rather comfortable with it, but it doesn't hurt to hit it one more time here. Prepare entries to account for short-term notes payable. Notes payable, huh? Here we're talking about a written promise. Unlike accounts payable, which has no written promise to pay, the short-term notes payable of any kind have a written component to pay a specified amount on a future date within a year. And within that note, they're going to talk about the interest. Most notes have interest that must be paid. And notes can come from anywhere. You borrow from a bank, that is a note. Or you have a customer who's slow in paying you, well, you can turn that into a note instead. Or you're the one being slow paying. You turn that into a note. Note given to extend credit. Okay, this is exactly what we're just talking about. On August 23rd, Brady Company asked McGraw, two Irish companies, I guess, huh? to accept $100 cash and a 60-day 12% $500 note to replace the existing $600 accounts payable. Okay. So what happened here is Brady is slow to pay its bills. The bill is due and they can't pay. So Brady and McGraw make a deal. Brady says, look, I can pay you $100 now of the 600, but you're going to have to trust me with a note and I'll pay you the remaining 500 in 1 year. Okay. So we have a journal entry here where we are Brady. We need to take the accounts payable down to zero with a debit and credit notes payable for 500, and we credit the cash for 100. So we've created a short-term note here, it looks like, 60-day note for $500. And I used to do that a little bit with customers where I worked for a number of years. Somebody couldn't pay us on time. It was in our best interest to reduce the debt to zero and change it into a note, which would at least give us some interest payments while the guy was trying to come up with the money. And it gave us a higher ability to collect in the event of a default. Notes receivable will always be paid before accounts receivable. And here we go. Brady now pays the note. They paid the note. Hey, that was a good deal. We debit the note $500 and we have to record $10 of interest expense, and the cash amount that we're going to pay is $510. Note the calculation of the interest. When you see $500 times 12%, that is 12% per year. That's 12% per year. So you have to prorate it into 2 months. 500 times 12%, that's $60. Divide that by a year. They're using 360 for convenience here, $10. Note given to borrow from bank. A company borrowed $2,000 from a bank. And the deal is 2,000, 60 days, 12%. You don't worry about the interest expense until it's due. At this point, it's just the liability. So on September 30, you debit cash for 2,000, credit notes payable. You set that liability up. 60 days go by, November 29, I guess. Now we pay it. We have to pay the notes payable. We reduce the note payable down to zero with a debit of 2,000, and we calculate the interest for 60 days. Again, 2,000 times 6 times 12 rather, it's what, 24,000 for 2 months? That's $40, okay? We calculate the interest expense to be $40. Our total cash payment, 2040. When note extends over 2 periods. Now, what we're getting into here is the need to accrue interest expense, I guess, huh? The note, when the note extends over a couple of periods, an adjusting journal entry is required to record interest expense incurred to date. So let's take a look at this. A company borrows $2,000 from a bank at 12% interest for 60 days. An adjusting entry is needed on December 31st. Why do we need a journal entry? Because it's overlapping the fiscal period. We borrowed the money in December. It's not due until February, but at the end of December, we've already accrued 1 month's expense. 1 month, the interest piles up at $10 per month or $5 per month, whatever it is. So let's take a look. We debit interest expense, credit interest payable. That gets us started. Now we're paying the note back. We're going to debit the note payable for $2,000. We've got the $10 that we already accrued from last year. We debit that, and the remaining $40 was accrued up until the payment of the note in February, another $30, okay? So we're going to debit the interest expense just for 30 because we already accrued the December expense. Now we're going to use that accrual of $10 to reduce the debt. Debit notes payable, credit cash 2340, okay? Compute and record employee payroll deductions and liabilities. I'll go over this a bit. We're going to try not to put this kind of information on the test, I don't think. There's a payroll class that I strongly recommend, taught by Pamela Fack. Well, you will become payroll experts. And passing that class is a nice thing to put on your first resume when you're looking for work. Payroll liabilities from salaries and wages. Obviously, the company owes money to the employees, but the company also owes money for employee benefits, payroll taxes, things like that. So let's see what we have here. We have gross pay, and subtracting from the gross pay, we're going to subtract FICA, Social Security, FICA, Medicare. Those are the 6.2% here for FICA, Social Security, 1.45% for Medicare. Social Security is the pension plan paid to senior citizens. I am now receiving Social Security. You are paying my Social Security. Medicare, this is medical bills. That's my health plan. And then any voluntary deductions. Maybe you tell your boss you want to join the 401k plan, or there are union dues involved, or health insurance, whatever. And then, of course, state and local taxes, federal taxes. So we go from gross pay to net pay. The journal entry, gross pay equals salaries expense. Net pay is cash. You debit the gross pay or the expense. That's going to be your debit to salaries and wages expense. And there is your credit to cash, net pay. All these items in the middle are called withholding liabilities. It's not the company's money, but they have a duty to turn your money over to the appropriate authorities. And FICA is, like I said, 6.2%. In this book, it goes up to the first 128,400 earned, 1.45% for Medicare on all wages earned. And FICA is what's called a regressive tax, because the more you earn, the less you pay. If you earn, say, $60,000 a year, just to pick a number, let's make it 100,000 a year, make it a bigger number. That means that you're going to pay $6,200 of your salary, or 6.2%. That's true for anybody who doesn't earn 128,400. But if you earn, say, $1 million, you have not paid a penny of taxes since you earned 128,400. So your percentage is not 6.2%, it's like 0.001 something. Okay. Regressive tax. Medicare is called a flat tax. Everybody pays the same no matter how much they make. And then you have the income taxes. We all sadly know what income taxes are: federal and state and local. Amounts withheld depend on the employee's earnings, tax rates, withholdings, how many children you claim, whatever. Employers must pay the taxes withheld from the employee's gross pay to the appropriate government agency. That's more than enough, I think, about payroll accounting. Employee voluntary deductions, union dues, savings account, pension contributions, etc. Employers own voluntary amounts withheld from employees' gross pay to the designated agency, right? Wow, look at this. An entry to record the payroll expenses for a company and deductions for what an employee might look like. Well, here we are. We have an employee, and this employee earned $2,000 for the week or the month, whatever. And look at the deductions that come out, huh? 6.2% for Social Security, 1.45% for Medicare. There was some federal income taxes payable there. Federal income tax came out. Medical insurance came out. Union dues. No state tax, at least, huh? The salaries payable, or the net pay, or the cash is $1,524. And since they recorded it to salaries payable to be paid the next day, then they just debit salaries payroll and credit the cash. Okay. Compute and record employer payroll taxes. What we spoke about just now is just the employee side, the employee money. But your employer pays taxes above that. The employer has to match whatever the employees paid in FICA and Medicare. Employers pay amount equal to that withheld from the employee's gross pay. So employer payroll taxes are FICA taxes plus Medicare to the extent that the employees paid. And then they also pay what's called unemployment taxes, FUTA and SUTA, federal unemployment tax, state unemployment tax, and they're very tiny percentages paid only by the company, not by the employee. And they're just showing you that federal unemployment taxes 6% on the first 7,000, and a credit is given to up to 5.4%. So therefore, the SUTA paid here is 0.6%, 5.4% for state up to 7,000, 6% up to 7,000 for FUTA. Come on now. And then we record the payroll taxes. We record the employer payroll taxes. Well, the employer pays Social Security, pays Medicare. Those two equal what was taken from the employee's checks. And they also have to pay state unemployment and federal unemployment. You debit payroll expense, payroll tax expense, and you credit the various liabilities. Well, we can talk a little bit about internal control of payroll. 4 key areas that should be separated and monitored. Employee hiring should be different from the person who prepares the payroll. And those two should be different from the people who record the time the employee worked, and they should be different from the person who's going to maybe hand out the paychecks. You want as many hands in the pie as you can, so that if any cheating to be done, 4 people would have to get together and kind of mess with it. Okay, internal control, you assign responsibilities to the area and make sure that they're not overlapping. Multi-period known liabilities includes unearned revenue and notes payable. Unearned revenue is a good example. Magazine subscriptions, a portion of the earned revenue is recognized each period as you reduce the unearned revenue. We've been over that quite a lot. Notes payable often extend over more than one accounting period. A 3-year note would be classified as a current liability for 1 year, long-term liability for 2 years. You borrow $1 million, $3 million today, you're going to credit current liability for $1 million, credit long-term liability for $2 million, and then collect your cash, the debited cash. Let's get into something a little bit newer, I think, maybe a little more interesting than the payroll. Account for estimated liabilities, warranties, bonuses. Let's see what we have here. An estimated liability is a known obligation on a certain amount, but it can be reasonably estimated. And examples are pension plans, healthcare, vacation pay, warranties, other things. Excuse me. Let's look at health and pension benefits. An employer expenses for pensions or medical, dental, life, disability. Assume an employer agrees to pay an annual amount of $8,000 for medical insurance and contribute money, 110% of the employee's 120,000 gross salary, to a retirement account. So that's pretty generous. So the employee has $8,000 of, excuse me, medical insurance expense and 12,000 or excuse me, please, or 12, 10% of 120,000 is 12. So there's your 20,000, 8%, 8,000 plus 12, $20,000 expense. The employee medical insurance payable is 8,000 and the retirement payable is 12. That is something of an estimate. You may not know exactly how much the employee is going to be making in terms with overtime or something. Vacation benefits. Assume an employee gets 2 weeks paid vacation each year. You have to record that expense in advance. You are going to record vacation expenses, debit, credit, vacation payable, vacation benefits payable. And what you need to do with your vacation accrual, the company-wide vacation accrual must equal the available vacation days for all of your employees. Okay, so you have an employee who is entitled to 2 weeks vacation, which is 10 days. At the end of the first month, that person has accrued 2 days of that vacation, and you're going to debit, in this case, $3,200 for expense and credit payable. You do that for all your employees. Auditors love to come in, look at your vacation accrual at month end, and make sure it ties in with what is actually owed to the employees. Well, what happens when the person goes on vacation for 2 weeks or 1 week here? Well, not a problem. We've already recorded the vacation expense. Now we just have to use the accrual we set up, the benefits payable. We debit that for $400. We credit cash for $400. Record the vacation. Bonus plans. Assume that a bonus of $10,000 is going to be paid to your employees. Well, you know about that debt now. You've decided upon it. It's non-callable. You record an expense called bonus expense or salaries expense dash bonus, credit bonus payable, and then you pay it later. Warranties, seller's obligation to replace or fix a product that fails to perform as expected within a certain period. Seller reports expected warranty expense in the period when revenue from the sale is recorded. So just think about that. We sold something, we sold $10,000 worth of goods this month, but our experience says 4% of that stuff is going to be returned under warranty. We have to recognize that expense right now, just like bad debt expense, if you remember that. The seller reports the warranty as an expense and a liability. A dealer sells a car for $16,000, maximum 1 year or $12,000 warranty covering parts. Past experience says the average of 4%, there's an average of 4% of a car's selling price that gets repaired. So we take 4% of the 16,000, we call that warranty expense, and we credit warranty payable or warranty estimated warranty liability. A warranty is like an insurance plan, if you will. You buy something, and if it breaks, not your fault, the company is on the hook for repairing it. Now, somebody actually returns the car for $200. In this case, well, we've already set up this liability for $640, so we're going to use it. Somebody just returned their car for repairs. We debit the liability for $200, and we credit, in this case, the inventory, the parts. It was just a matter of replacing parts. It could have been labor involved, then we have the labor. Contingent liabilities. These I kind of like. Contingent liabilities. Hope you find this part interesting. Contingent. Contingent. What does contingent mean? Contingency. It means accounting. It means that a certain event will happen in the future depending on behavior today. For example, I will lose weight if I go on a diet. You will earn A's in the class if you study hard. Okay? Contingent liabilities, they may or may not take place, and proper accounting says we need to judge them and apply the appropriate GAAP rules. So contingency, maybe is a good word for that, Future event, if the future event is probable, okay, and we can estimate the amount reasonably, and if it's estimatable, we record the liability. Let me repeat that a little more clearly. We're getting sued by somebody, and it's probable we're going to lose the case. Probable. Doesn't look good. Our attorneys say that it doesn't look good for us, okay? So we probably are going to lose the case. If we can estimate how much the damage is going to be, we record that as an expense immediately, called contingency expense or something, and credit a payable. You must take the hit on your income statement as soon as you know that you're probably going to lose the lawsuit and you can estimate the amount. But if you can't estimate the amount, you have no idea what the damages might be, then you are not going to record the liability. But boy, you're going to put a big paragraph on that in your notes of disclosure to let people know what's going on. If somebody sues us, but we're not sure if we can win or lose, our lawyers say it could go either way. In that case, we just record it in the notes. There's no liability. And if we get a lawsuit that's so stupid and ridiculous that there's no way we're going to lose it, remote, you don't do anything, okay? So if we can estimate it and we think we're going to lose the case, we record the expense. If it's 50-50, we're not sure, then all you're required to do is put it in the notes. And here is a little description. Reasonably possible. Well, a potential claim is recorded if the amount can be reasonably estimated and payment for damages is probable. You know, one of our employees was backing a car out. One of our employees was backing a truck out and hit another car and did considerable damage, and we're being sued. That would be probably a potential legal claim that we need to record. Debt guarantees. The guarantor usually discloses the guarantee in the financial statement. If it's probable that the debtor will default, the guarantor reports that the guarantee as a liability. Other contingencies, environmental damage, that's a big one. Tax assessments, insurance losses, government investigations. You have a factory somewhere, and the EPA, the Environmental Protection Agency, comes in, and they see that you're spilling harmful chemicals. Well, that's a lawsuit you're probably going to lose, and that would be a different type of contingency, okay? Other contingencies, environmental damage, tax assessments, insurance losses, uncertainties from future events are not contingent liabilities because they're future events and don't arise from past transactions. These are not disclosed, okay? Contingent liabilities. And let's get into a metric. Here we go. We all like metrics, math. Compute the times interest ratio, times interest earned ratio. Use it to analyze liabilities. Here it is. We're going to take the income before interest and income taxes, income before interest and income taxes, in other words, your net income before taxes, and simply divide it by the interest expense. If the income before interest and taxes varies greatly from year to year, fixed interest charges can increase the risk that an owner will not earn a positive return and be unable to pay interest charges, So what we're saying, we're making sure at least that our net income certainly covers our interest expense, okay? Times earned interest. And here's an example of some companies. Here the income before on 2019. What company do they tell us what company this is? I guess, Diego. Company named Diego. In 2019, they had sales of 600, expenses 450, income before interest was 150, interest expense was 60, net income 90. They divide out 150 divided by 60, and their net income is 2.5 times their interest expense. So they have the ability to pay down their interest expense. Although I got to tell you, $60,000 in interest expense on overall income, that's a 40% click there. And that takes us to the end of the chapter. I hope I was able to help you out a little bit with this. The liability section here, this chapter is not the most exciting, but you need to go over it and get familiar with the different definitions and things. I don't think it's too bad. Anyway, thanks for hanging in there with me, and we will see you on Wednesday.